If you've spent any time looking into Roth conversions on here lately, you've probably noticed that almost everybody is telling you not to do one. I've been a financial planner here in California for a long time, and I've created retirement plans for hundreds of people. And honestly, a lot of that pushback is fair. I've made videos myself on how conversions get oversold and how a lot of people just jump into them because they heard a buzzword on the internet before actually running the math on their own situations. But that leaves you in a strange spot, because if the answer is usually no, then what are the exact conditions that would lead us to say yes, that Roth conversion is a good idea? And that's what today is about. We really do like Roth conversions in our practice, we just like them in specific circumstances. And after doing this long enough, you start to see the same green lights that tend to show up over and over and over again. There are 5 of them. Almost nobody has all 5, but you need to have at least a few of them before any of this makes any sense at all. We're going to start with the one that flips the single most common piece of Roth conversion advice you'll ever hear on its head. And that's that you always want to proceed with your Roth conversions in years that you have less income. For a lot of people, those are actually the most expensive years you'll ever convert in. And here in a little bit, we'll go over the math on why exactly that is. And then there's one reason that's probably the strongest reason, I think, that you ever want to convert that nobody really tends to talk about. I'll cover that one later. And quickly, if you'd like help mapping this out for your own situation, there's a link in the description you can click and book a call with my team. My team and I build retirement income plans for people all day, every day. We're happy to go over where we think you stand. Now let's get into it. Okay, so let's start by going over what we're actually betting on and what a conversion actually is, because a lot of the content I'm seeing out there on the internet about Roth conversions makes us think that this is some kind of trick. And it's not a trick. So let's say you have money in a 401k or a traditional IRA, and that money exists because you made a deposit that you did not pay income tax on at the time. You deferred taxation when you signed up for the 401k and deferred some of your compensation into the plan. That money got invested and the balance grew over time. Well, you've not paid income tax on that money. A conversion is simply if you take some of that money in the 401k or an IRA and you move it into a Roth IRA. When you do that, it's a taxable event. You pay tax on the amount that gets moved from the 401k or traditional IRA, whatever the tax deferred account is, into the Roth IRA. Rest assured, you'll get a 1099 from your broker that year, at the end of that year, for the exact amount that moves from the deferred account into the Roth IRA. Once the money makes its way into the Roth IRA, at that point, you've settled up with the IRS. You never pay tax on that money again as long as it remains in the Roth IRA. So this really isn't a tax-free strategy, it's a timing decision. And what you're trying to evaluate is whether your marginal tax bracket is going to be higher now or higher later. Because if you think that you're in a higher tax bracket now than you're going to be later, then you don't want to do a conversion. You want the taxable event to occur in the years when you're in a lower tax bracket. That's what everything else in this video is going to be about, is how to evaluate that decision of timing. One more thing quickly before we get going. Years ago, you used to be able to reverse one of these conversions. If you executed one of these conversions early in the year and you decided, yeah, this really wasn't for me, that was a bad decision, I want to change it. Years ago, you used to be able to walk that decision back. That is no longer the case. If you make a Roth conversion, if you execute a Roth conversion now, it's permanent. You do not get to reverse that transaction. So make sure that you measure twice and cut once if you're going to do this. So to make this real, I want to introduce you to a hypothetical couple, Curtis and Yvonne Hollis. They're both 63. They live in Rocklin, California, not too far away from our office here outside of Sacramento. Curtis ran operations for a local food distributor here in the Sacramento area for 29 years. He had a nice long career. Yvonne handled payroll for a group of dental practices here locally as well. Curtis has a half-finished 1968 Ford Bronco sitting in his garage. He's been threatening to finish it for the last 6 or 7 years and claims that this is finally the year that he's going to get to it. The numbers look like this. Here are the hypothetical figures that I came up with to make this example for Curtis and Yvonne. So they've got about $1.6 million saved. And of that $1.6 million, $1,150,000 of it exists in a traditional IRA. That's a rollover from Curtis's 401k plan from the food distributor he worked at for 29 years. Yvonne has $180,000 in a Roth IRA, and they have $270,000 in a joint joint taxable account. On top of that, they keep about $60,000 in a high-yield savings account for their emergency fund. That detail will be relevant later. And they want to spend about $7,800 per month in retirement, which works out to about $93,600 per year. They don't have a pension, but they're both eligible for Social Security from their work experience. Yvonne is planning to file at full retirement age, which is 67 for her. Curtis is planning to wait until age 70. So Curtis has been reading about Roth conversions for about a year, and he is ready to go. And on paper, his interpretation is that they're a textbook case for Roth conversions. They're 63, they both just retired. They have no earned income. They have no guaranteed income from pensions. They haven't turned on Social Security yet. Their only income comes from any distributions they want to take from their tax-deferred traditional IRA and interest and dividends and gains that come off of the taxable brokerage account. So they're in a much lower bracket now than they were in the past and than they think they will be in the future, which makes Curtis think that this is a phenomenal time for them to proceed with the conversion. Which brings us to the first green light, and the reason that Curtis converting this year may actually be one of the most expensive things that he ever does. So green light number one is that you're on the cheap side of the window. You've probably heard about the window before. The window is the period of time after you retire, before Social Security turns on, and before the IRS forces you to start taking money out of your accounts through mandatory distributions every single year. Income is up here while you're working, and then you stop working. Well, you're probably going to be in a much lower bracket, right? So there's the window after you stop working, before Social Security turns on, before mandatory distributions start kicking in and could theoretically push you into a higher bracket. But if you retire before you're 65, that window has two very different halves. Half one is before you turn 65, half two is after you turn 65. And the reason that 65 is the line of demarcation, the reason we split it into two, is health insurance. Most people who retire before 65, they're not on Medicare yet. They obtain their health coverage through a state exchange marketplace plan. And the thing is, the amount that you pay for that health insurance plan depends on your income. The less income that you have, the more the government subsidizes this through a premium tax credit, and the less you wind up paying out of pocket on a monthly basis. The catch here is how it's built. It's not a sloped line where a little bit more income means that you pay a little bit more for your health insurance. It's a cliff. And if your income puts you over that cliff, you're losing the entirety of that subsidy from the federal government and could wind up paying a ton more for your health coverage. So a Roth conversion in those years doesn't just cost you the potential income tax from the conversion, it can theoretically cost you the entire premium subsidy for your health care. Right now, Curtis and Yvonne are funding their spending needs out of their brokerage account, so their income is remaining pretty low. Remember, they have $270,000 in a taxable brokerage account, and that account will produce some dividends and interest and gains every year, and if they sell assets to meet their spending needs, they'll pay a modest long-term taxable gain on that, but all those things considered, their income will be pretty low, which enables them to capture more of these premium subsidies, and the basic middle-of-the-road silver plan that they're enrolled in with these subsidies cost them $200 per month out of pocket. But if they paid for the plan on their own without the subsidies, that would cost them $2,300 per month. Let's do this for Curtis and Yvonne. They're both 63 and they're both on a marketplace health plan. Now let's say Curtis converts $60,000, which honestly, for a couple with 1.15 million saved in pre-tax accounts is a fairly modest amount. Well, if you convert $60,000, that pushes their income above 400% of the federal poverty line, which this year is $84,600 for a household of two. Now, the total cost of the conversion from an income tax perspective is about $6,100. By converting $60,000 in the pre-tax accounts, it would result in a total additional income tax owed of about $6,100 between what's owed to the IRS and the state of California. But that's not the only cost, because by launching over that 400% cliff, now Curtis and Yvonne are losing the entirety of that premium subsidy, which, if you recall, is the difference between paying $2,300 and $200 a month for their health care, which over an annual basis is $25,200. And if you add the extra income tax to the premium subsidy that's lost and then divide it back into the amount that they converted, the total cost of this conversion isn't just the low tax bracket that Curtis was expecting. It comes out closer to 52% of the amount that he actually converted. He thought he was converting at a low rate. He wasn't. Now, let's wait 2 years and run the exact exact same conversion once Curtis and Yvonne are both 65 and enrolled in Medicare. Extra income still costs them something. It's called the Medicare premium surcharge, and if their income goes beyond a certain threshold, you need to pay more money for their Medicare premiums. In 2026, the standard Medicare Part B premium is $202.90. But if your income pushes you into that first tier of the surcharges, your Part B premium goes up to $284.10 plus an extra $14.50 a month for whatever you're paying for Part D. And that's not combined, that's for each of both Curtis and Yvonne. So if you annualize that over the year, that's an extra $2,296.80. Now that's real money. I don't want to wave it off. But let's look at the difference in kind. Before 65, going $1 too far costs you the entire premium subsidy, which is a huge amount of money. After 65, going $1 too far just means you're paying a little bit more for your Medicare premiums. Same conversion, wildly different price tags, and the only thing that changed was which side of 65 they were standing on. So the green light number one is this: your healthcare premiums aren't tied to your income at all, which means either you're already 65 and you're in Medicare, or you're in some health plan from a prior employer, some maybe retirement plan, or you're obtaining your healthcare from a spouse's current employer's coverage. Now, I want to be fair here. This doesn't mean that converting before the age of 65 is absolutely wrong. If you're far enough under the cliff to where you can convert a little amount and still remain in that interest or that premium subsidy area, that can be completely okay. The point is that the amount of room you have is a lot smaller than most people realize, and this is a cliff we're not talking about, just a step into a slightly different price tag. It's a massive, massive amount of money if you go too far and lose that premium subsidy entirely. So that's the cost side of the bet. Now let's talk about the other side, which is the rate at which you're comparing things to. Because almost every married couple I've ever sat with gets this number wrong, and I think it might be one of the most important of the 5 green lights we'll talk about today. Now, when people compare their rate today versus their rate later, married couples tend to compare a married filing jointly return today versus a married filing jointly return for some point in the future. And it seems like the right comparison. It's the same household, same people, same money, just some point in the future. But most couples don't pass away in the same year. Realistically, one of them is going to predecease the other, resulting in the surviving spouse filing a single filer status tax return for at least some number of years. The money might stay the same in terms of monthly expenses and cash flow and so forth, but the tax return is going to look quite a bit different. Think about what actually happens here. When one spouse predeceases the other, the household Social Security benefit does go down by a little bit, and it would revert to the higher of the two couples' respective Social Security benefits. So whichever spouse had the higher benefit is what the surviving spouse is going to continue receiving after the death of the first spouse, whether it was their own or it's a survivor's benefit from what their spouse was collecting. But the IRA balance doesn't change, right? The RMDs every year, they don't change. You're still expected to take out the exact same portion every single year, whether it's one person in a household or two. The balance is the balance, and the portion you're expected to distribute every single year keeps climbing. So now you've got almost the same taxable income being squeezed into a single filer's return instead of a married couple filing jointly. And that return is squeezed in 4 separate places at the same time. First off, the standard deduction is exactly half for a single filer of what it is for a married couple filing jointly. In 2026, a married couple filing a joint tax return has a standard deduction of $32,200. A single filer only gets a standard deduction of $16,100. The brackets themselves, the tax brackets themselves, are half as wide. So if you have the same amount of income, you're climbing through them twice as fast. The Medicare premium surcharge thresholds are roughly half for single filers compared to married couples filing jointly. And the thresholds that determine how much of your Social Security benefits are considered taxable income are lower, and they're compressed for a single filer compared to a married couple filing jointly. For a single filer, the phase-out thresholds are $25,000 and $34,000 of income compared to $32,000 and $44,000 for a married couple filing jointly. And interestingly, those particular numbers have never once been adjusted for inflation because that's how they were written into the law decades and decades ago. That's 4 squeezes at once on almost exactly the same money. So now let's put Yvonne in this exact situation, because even though they're the same age, she and Curtis are the same age, based on health and family longevity history, Yvonne is likely to live longer. So let's say that Curtis passes in the year that both he and Yvonne turn 76. Now let's fast forward a couple years to the year Yvonne is 78 and filing as a single tax filer. Her Social Security benefit is going to step up a little bit because she'll be collecting the greater of her own benefit or Curtis's. Since Curtis's was higher, this would be about $3,900 a month because that's a little more than what she was collecting on her own earnings record. If they get reasonable long-term growth out of their pre-tax accounts, those pre-tax accounts that are worth $1.15 million today will be worth about $2.1 million at that point. And given her age, that makes Yvonne's mandatory distribution in that year $92,347. You run those numbers as a joint tax return, and that puts her in the 22% bracket. But as a single filer, she jumps into the 24% bracket, which may not be that big of a deal, if not for the fact that more of her Social Security is going to be taxed as income, and she's going to find herself in the third Medicare premium surcharge tier, which of course means that in that year, she'll be paying an extra $324.60 per month for Part B and an extra $60.40 per month for Part D. Nothing about her money changed at all. She was just forced to use a different filing status. This is the strongest argument for converting that I know of, and the reason that is that it doesn't require you to guess about anything. Every other case for converting rests on some kind of prediction. Rates are going to go up, Congress is going to do this, federal debt will do that, which is going to require some form of additional taxation in the future. Those are all predictions that we really don't know whether or not are going to come to fruition. And speculatively, I don't know that I buy those arguments anyway. Now let's get to green light number 3, because this one decides which dollars you convert, not just how many. Now, if you're watching this and you're starting to wonder whether your situation has any of these green lights turned on, your health coverage, your future brackets, what happens to your survivor, all of it, my team and I work on this every single day. There's a link in the description. Feel free to click it, book a call with our team. We're more than happy to go over your personal situation and help you identify whether these lights are green for you and your family. And notice the timing that this creates. The only years where you can convert at joint rates are the years where you're both here. And that window closes for most people, and it closes without warning. This one doesn't need any prediction at all. Congress doesn't have to lift a finger. Rates don't have to change. One spouse just needs to predecease the other, which in practice is usually what happens. A conversion is a prepayment. You hand the IRS money today, and what you get back is years of growth that doesn't get taxed again, which means the value of the conversion depends entirely on how long that money remains in the Roth account after the conversion. So think about what happens if you decide to convert money that you're planning to spend at age 68. You paid the tax a few years early, the money sat in the Roth account for a few years, and then you took it out and you spent it. In that scenario, you got almost nothing for it. What you could have done is just paid the tax a few years later and simply taken the distribution when you needed the money. The dollars that make the conversions genuinely powerful are the ones at the very back end of your plan. It's the money that you don't plan to spend until you're 85 or 90, or maybe not even at all. Maybe it's the money that you plan to bequeath to your kids that they'll inherit from you. Those dollars get 20, 25 years or more of tax-free compounding, and those are the dollars where the benefit really lives. So the practical rule here is to try to convert from the tail of your spending plan, not from the front of it. For Curtis and Yvonne, the money that funds their plan should come out of the brokerage account first, the taxable account, and then out of Social Security once they decide to turn their benefits on. That's the front of their plan. It should never be out of the money that they're planning on converting, which means that the conversion candidates are those deep pre-tax dollars, the dollars in the pre-tax accounts that they don't plan to spend for a decade and a half or longer. And this is also why converting aggressively in the first couple of years of retirement often disappoints people. In those first couple of years, you haven't lived it yet. You don't really know what things cost, and early retirement tends to be a lot more expensive than people really realize. So if you double that up with a big tax bill, that's surprising, it's disappointing, and often it pushes people through the lower brackets into the higher brackets that they were simply trying to avoid in the first place. Green light number 3 is when you can point at the dollars you're about to convert and honestly say that you don't expect to spend them for another 15 years or more. That's which dollars. Now, for the test that disqualifies more people than anything that I've mentioned so far in this video. Now, when you convert, you owe tax that year, and there are 2 ways to pay it. They're not even close to equivalent. Let's say you're in the 22% tax bracket, you convert $100,000. That means that you're going to owe tax of $22,000 that year. Option 1 here is to withhold from the transaction, which basically means you tell your broker to take a little bit of money out of what's being converted and send that to the IRS for you. So $100,000 leaves your pre-tax IRA, $22,000 of it is withheld by your broker, and $78,000 that's remaining is what winds up in your Roth IRA. And the $22,000 that your broker is holding gets sent to the IRS on your behalf to pay the taxes. For just a second, think about what happened. The whole point of the exercise is to get more of your money into these tax-free Roth accounts that are never going to have mandatory distributions, that will grow tax-free for the rest of your life and for some of your beneficiaries' lives based on their distribution requirements. And by withholding from the transaction to pay the taxes, you've just shrunk that pile by 22%, which goes against the purpose of doing this in the first place. You've basically shot yourself in the foot on the way to the door. Option 2 is to pay that money from some other source, like cash that you have in the bank or maybe from a brokerage account. And that's easily the preferable way to go because it means that $100,000 leaves your pre-tax IRA and $100,000 winds up in the Roth account. That's precisely what we were after initially. For Curtis and Yvonne, remember, they have $60,000 sitting in a savings account for a rainy day, for an emergency fund. That's precisely the money that they should use to pay the taxes because they're not earning very much interest on that cash, and inflation is eating away at it every single year. That's basically the ideal money that you want to use for this thing because you're taking your least productive dollars and using them to preserve your most productive dollars so that more money can wind up in the Roth accounts and grow at a higher rate, all tax-free from this point forward. And one more note here, if you're under 59 and a half, withholding for taxes on a conversion can be treated as an early distribution. So not only are you paying tax on the amount that comes out to pay the tax, paying an extra 10% on it theoretically. So green light number 4 is that you have your cash or taxable assets that you can use to pay the tax on a Roth conversion. And when you do that, you're not totally draining your emergency fund down to zero. You still have some emergency fund there ready for you for a rainy day, just in the off chance that you need it. Now, if you don't have that emergency fund in place yet, the answer isn't no, you should never convert to a Roth IRA. It's probably that no, just not yet. And that brings us to the last one, green light number 5, which honestly is probably the least exciting, but it does decide in more cases than any of the other 4 combined. Almost every conversation I have about Roth conversions, when I see people talk themselves into it, it traces back to one fear, and that's the tax bomb at age 75. The idea is that once you hit age 75, mandatory distributions are going to kick in, and the IRS is going to come knocking and force a huge amount of money out of your pre-tax accounts and then push you into a higher bracket that you'll never be able to escape from. That can happen. I've seen it many times. But before you jump to that conclusion, you have to actually run the numbers for your own situation. Now, the math is a little simpler than people expect. The way this works, in the year you turn 75, you take your life expectancy that the IRS gives you from an actuarial table, you take the balance in your pre-tax accounts at the end of the previous year, and you divide by what that life expectancy number is. And right now, based on the actuarial tables, that number in the year you turn 75 is 24.6. So the math works out to roughly 4% of your account balance in year 1 of your mandatory distributions. And every year from that point on, as your life expectancy goes down because you're getting older, the denominator in that equation gets smaller, and you need to take out a larger and larger portion every single year. Now, here's the test that nobody runs. Take that projected distribution that the IRS is going to force out of your account and compare it to what you are going to spend anyway for your own needs. Because if you need $70,000 out of your account in a given year to meet your spending plans, and the IRS is going to force $52,000 out, that's not a tax bomb. You're going to take that money out anyway. The difference is just the paperwork required to satisfy the distribution needs. This only becomes a problem when the forced number climbs past what you were going to take out anyway beyond your Social Security benefits. For Curtis and Yvonne, that pre-tax account of $1.15 million, if they get reasonable growth, by the time they're 75, that projects out to about $1.9 million, a little bit more than $1.9 million. Divide that number by 24.6, and you get a first-year distribution requirement of about $77,000. Their spending need at that point, adjusted for inflation, will be about $10,800. After you adjust their Social Security benefits for inflation, they'll have about $9,700 of it covered from Social Security. So the amount that they need to take out of their accounts is actually only about $1,100 a month, or a little bit more than $13,000 per year, not the $77,000 that will be forced out by the IRS. Now, if that forced number lands below what they needed to take out anyway, there's no tax bomb, there's no reason to convert, and deciding to convert and pay tax early on the amount that was going to come out anyway, it just doesn't make any sense. It's solving a problem that they didn't really have in the first place. Now, if the forced distribution lands above what they would have taken out anyway, and in Yvonne's case, she's potentially filing a single filer tax return on top of that, now we have green lights 2 and 5 flashing simultaneously. And that's a situation where converting a specific amount in specific years can really make a substantial difference. Now, I'll say this plainly because I've said it before and I still believe it. For a lot of people with less than about $2 million saved in pre-tax accounts, this green light simply doesn't turn on. Your income usually falls when you stop working, your deduction gets bigger, not all your Social Security benefits are taxable, and the forced distributions don't push you anywhere that you weren't already headed. If that's you, you may be better off just waiting this thing out. Don't do the conversion, just take the money out naturally when it was going to come out anyway, because that will result in lower marginal rates. Converting in that situation isn't really clever, it's simply prepaying a tax bill that you weren't going to get anyway. So let's put these 5 together because they don't all carry the same weight. 2 of them are really gates. One of them has to do with healthcare. If you're obtaining healthcare from a source where the cost that you pay depends on your income, that's one of them. The second one has to do with whether you have assets in a checking account or a taxable account that can be deployed toward paying the tax on a conversion. That's the second one. If you fail either of those gates, the answer to whether I should convert right now is probably no or not yet, because it's really rarely a good idea to proceed with the conversion until you pass both of those tests. The other 3 are reasons: the survivor's tax bracket, the tail of your spending plan, and whether or not your ordinary distributions are going to outpace the forced distributions from the minimum distributions when you're 75 and older. You need at least one of these lights to be turned on clearly and honestly, not hopefully. Almost nobody has all 5. If your gates are open and you have at least one strong reason, that's justification to do some modeling and analysis carefully. If your 2 gates are open and you have 2 or maybe 3 reasons working to your benefit, then that's a pretty good argument for converting some in specific years. And notice what this never adds up to. It never adds up to converting the entirety of your account in a specific year. It adds up to converting a specific amount of money to stay within certain thresholds in specific years only. So those are the 5 green lights, and how you can tell whether your situation actually has any of them turned on. But here's the thing, after building retirement plans for people for about 20 years, these Roth conversion green lights aren't actually what tells people whether they have success in their own retirement plan. There are a handful of lessons I've learned from people going through 20 and 30-year retirements that I've picked up along the way, thankfully, that just went against conventional wisdom, or what I thought was conventional wisdom when I started out. One of them completely changed the way that I look at money in retirement now. I have another video for it. I'll cue that one up next. That's what I would suggest you watch.